Thanks everyone for coming. We've got four great panelists sort of sitting across both the more philanthropic side of the capital spectrum as well as the implementation side on the sort of front lines in Africa. So hopefully this will be an insightful panel for everyone. We have a pretty broad sort of agenda in terms of thinking about how sort of inclusive and catalytic financial structures can help unlock sustainable development on the continent. I'm going to ask everyone to briefly introduce themselves, try and keep it to 1 minute for time, both yourself and the organization you work for. And then I'm going to ask each in turn to tell a little bit more about sort of what inclusive and catalytic finance means to them, the types of tools they have at their disposal, and maybe a couple of examples of the work some of the organizations are doing more on the funding side, and then the specific strategies that the fund managers are doing. We'll probably try and keep it to about 25, 30 minutes, so there's some time for some questions at the end, because that's usually more interesting. So, great. So I'll start on my left and move along.
Happy to get started. Good morning, everybody. Pleasure to be here. Ulrich Hess with GIZ. We are a technical assistance organization supporting basically markets in Africa and elsewhere through technical assistance, supporting both market building, sort of, as well as pipeline building. So in this space, we support specifically now with ICAMA, which is innovative capital mobilization in Africa. We help to set up sort of game-changing new financing vehicles that hopefully move the needle in terms of local capital mobilization. So over to you.
Thank you. Hello, everyone. I'm Julie Blumel-Gascoigne. I work with Save the Children Global Ventures, which is the impact investment and blended finance branch of the international organization Save the Children. So as Save the Children, we're present in 100+ countries around the globe, both in the developed and the developing world. Save the Children Global Ventures tries to catalyze and mobilize funding for impact on children in around the globe, but with a specific mandate on the developing countries. And I'll go more into details later and hand over to you.
Thank you. Olen Machimbega, Senior Vice President at Verdant Capital. So Verdant Capital is a Pan-African investment banking and investment management firm headquartered in Joburg, South Africa, but I'm based at our office in Zimbabwe. So I sit on the investment management side, where we are managing a hybrid fund that's investing hybrid capital instruments into inclusive financial institutions in Africa.
My name is Sietse Wouters. I'm from the UBS Optimus Foundation. We are an independent foundation set up by UBS, a vehicle for clients to support their philanthropy. So all our costs are covered by UBS. We do grant making on the one hand, and on the other hand, we do direct investments, a bit of fund investments, and increasingly we want to do more blended finance type structures where we can work together with the bank to really leverage more private capital into the development sector. Focus is education, health, and climate, and we're present across Europe, in Asia, and the Americas in terms of where we acquire our donations from, and then we mostly focus on Sub-Saharan Africa, South Asia, and Southeast Asia.
Great. Well, thanks everyone. Good brevity from everyone. Very impressive. So I'm going to ask sort of I think 3 questions I'd love you all to answer. So one, basically addressing the question this panel poses, like for you and your organization, why do you believe that catalytic finance can be one of the keys, to unlocking sustainable development on the continent? I think secondly, it'd be great to expand a little bit on the types of tools you have to help deploy, facilitate that. And then thirdly, certainly for GIZ and UBS to talk about maybe one exciting example that you think demonstrates that well, and then obviously for the fund managers to talk about their strategies. I think in order it would make sense to start with the sort of public sector with Ulrich, then move to the sort of philanthropic sector with CITSA, and then we'll talk about the two fund strategies that are very specific. Does that sound good?
Yeah, I think catalytic finance can play a crucial role in mobilizing finance, mobilizing capital, in terms of the real capital, the large pools of capital are really in Africa itself. So we are talking we are talking pension funds, institutional investors, insurers, etc. These are local funds that are usually not deployed sufficiently in innovative in companies, really. It's usually government bonds that they go into. So I think here we have an opportunity to unlock through catalytic finance these large pools of capital, and we are trying to do this. That's kind of the second part of the question. With ICAMA, we are trying to facilitate these fund of funds that actually crowd in pension fund money through catalytic finance. So there is a sort of a first loss, a junior tranche, where catalytic finance ultimately comforts sort of the senior tranche where a pension fund can invest in this in venture and P&D. So that's kind of one perhaps exciting story, I think, that we try to do, where catalytic finance can play a major unlocking role, catalytic role, really. The other one is perhaps a more general or typical role that we play. We support regulatory frameworks, policy frameworks in countries. We set up, we help international sustainability standards to come along to the IISSB. So to kind of get the framework right, for investing in this impact space. But I stop here. I talk too much.
Thank you.
Over to you.
And over to CITSA.
Thanks, Ulrich. I think one of the key attributes of catalytic finance is really its flexibility, its ability to do things that investors might not be able to do because of their investment restrictions. At the same time, especially when you, as a philanthropic organization, can do such investments. For example, in our case, we're quite free in applying that money, which allows the fund managers, the investees, to really apply that money where it's most needed without restrictions. And I think that's the helpful part for catalytic capital, to really be useful where it's needed. And I think that was also a very clear message from an earlier session I was joining on carbon, really that need for this type of seed capital, investment capital, to enable a lot of these areas where we're interested in. Carbon is one of them, but also education, health, employment is an area we're very, very interested in, to really help those become investable and bring in those investors that will bring perhaps the bulk of the capital after that, once there's a bit more track record. So that's really, I think, the strength that I really see for catalytic capital.
Thank you. And maybe Julie, you can take the floor.
So I think what is our starting point is really the impact that we want to create on children. So everything that we do it with a child lens, and to create this sustainable impact for children. And when we say children, it's generally accepted as an evidence that people should be investing in children, in future generations, to achieve sustainable development. But the fact is that in our, if you look at the investment strategies, KPIs, there's really almost nothing around children, and we're trying to change that, and we're trying, through the work that we're doing at Save the Children Global Ventures, to prove that investing in children and companies and sectors that have a positive impact on children is really an investable opportunity. So we go about it. And I would say from the mobilization perspective, where we're trying to really build funds that speak to the different abilities in terms of concessionality, flexibility of the funders that we're speaking to. So we have a venture philanthropy vehicle, which is fully grant funded, but that we're deploying with a capital investment lens, right, into startups that are operating in mission-aligned sectors. And we also have several other funds that we're currently structuring or that are already existing that speak more to the type of institutional investors that you were speaking about. And I think on the deployment side of things, what is also really important for us is to equip, as you said, the actors in the markets with the tools to be able to go into these child-aligned sectors, because it's, I would say also, given that we don't have the KPIs and we don't really necessarily have the depth of portfolios yet, I think there's really a learning path for different financial institutions, for instance, that we're trying to support. And for that, you needed the de-risking to bring the actors in.
Thank you. And over to you, Olin.
Well, thanks, Harry. So I mean, so it says, as I mentioned, we have a fund that's investing hybrid capital into inclusive financial institutions in Africa. Our biggest investor is KfW, the German DFI. You know, DFIs are very serious about development and social impact generation in the countries that we operate. So in terms of, you know, catalytic finance, what it means to us is, as I mentioned, we're doing hybrid capital instruments into financial institutions. We want to strengthen the capital position of their balance sheets so that they don't breach their leverage covenants. So we basically, when we're looking at the debt to equity ratio, we're basically part of the E. So when we put more of the E, the ratio comes down. That creates more room for the financial institutions to bring more of the D without becoming highly leveraged. That's where we're coming from. In addition to that, I can say we invested in a lending group called LOLC Africa. They're headquartered in Sri Lanka. We're the first external investor. In June 2023, we gave them $9 million. We topped up another 4.5 this year. And then we saw additional lenders coming on board, supporting the Africa business. We invested in Watu Credit in Uganda back in 2022. That was our first investment. We saw other investors like FMO following the path. So, I mean, when we support these financial institutions to strengthen their capital base, we're basically allowing them to unlock additional capital in terms of, you know, raising additional senior debt funding from different investors. I think the loan books of, you know, these lending players has grown, you know, by more than 10 times than it was at that time when we invested. So I think that's a great initiative for us. In addition to that, we have a €4.5 million TF facility from KfW that's aimed at strengthening the organizational capacities of the companies that we invest in, as well as improving financial inclusion strategy for a fund. We have done several tier projects for portfolio companies across different things such as ESG development and implementation, social rating, and client protection pre-certification. So we work with very reputable consultants that we appoint to execute such tier projects on our behalf.
Thank you. So one question, and feel free to jump in, I have is, you know, sort of particularly on the sort of funder side, you know, making the case for why you should be providing catalytic capital internally and, you know, often subsidizing other investors. How much of a challenge is that, and the sort of narrative you have to bring to, you know, to make that case to your stakeholders?
Do you want to get started?
I mean, to be frank, it's a challenge. And it's something we are getting better at because, we're funded by donations from clients. We receive around $400 million a year. Most of that comes in restricted form. So what we're trying to do is really try to get that money in an unrestricted form. What's really helping is the more evidence we have, the more examples we have of projects, is that really helps us in making our case. But the money coming in is very diverse. I mean, on the one hand, you have maybe the old retired lady giving her estate to the foundation. On the other hand, we have venture capitalists who've made billions on the market, who don't believe in charity but only believe in social investing. So it's a very broad set of clients. And what we offer is specifically focused to those clients that want to work through investments. So we as a foundation come in, make these kind of philanthropic catalytic contributions, potentially get that money back and then reinvest it into these causes. But also it's important that you do fail sometimes, and I think an example of that is we've been investing in the past in supporting low-cost schools through loans. It really didn't work for us. This is already probably 7-8 years back. And now we're actually going to look at an example that Julie's team is doing, which is doing something similar, but different. And I think it's important there as well. Try things, fail, look at why things fail, and then try again. And I think that's the really important catalytic part that's needed in the space.
Yeah. Thanks. Any thoughts, Ulrich, or I have more questions?
Yeah, I think, it's an easy sell, actually, because we have the evidence. We have the evidence in terms of how pipeline building, technical assistance for basically project preparation. We have an example of Get Invest, where we actually work with GCF money, Global Climate Fund, to prepare projects, 20 billion worth of project development. So that's a good investment. It crowds in private investors. Another example is where we can actually make the case for catalytic finance, where you have the data to show that with a certain amount of, let's say, junior tranche of 30%, you crowd in these large and institutional investors. Why? Because it covers exactly the risk that can be shown. There's evidence where how much failure rate there is. So it works. I mean, it's a good sell.
That's a really interesting point. I want to just follow up, intrigued if anyone has views, is I think there's some really interesting research recently on sort of smallholder agriculture focused funds globally. And one of the big takeaways was that, these things are all like massively over collateralized from a blended finance perspective. And like the actual sort of unlocking and leverage is pretty low for your sort of bang for your buck. The underlying strategies are incredibly impactful, but so I'm intrigued sort of your reflections on that, because we all obviously want to mobilize, but the reality is, the sort of real money is pretty far away from where we're all inhabiting, I think, in the ecosystem.
Yeah, thanks, Eric. I wanted to add that, as I mentioned, KfW is our biggest investor in our fund. It has not been challenging for us, but KfW being the first investor in our fund, when we launched the fund about 3.5 to 4 years ago, they trusted our model. We had already built a good track record with inclusive financial institutions from our advisory, because our company started operating in 2013. They believed our model, they believed our track record of working with IFIs in Africa. We have a 4.5-year facility from them. We're actually under pressure to deploy it. So we contribute 80% of the tier project cost, and then the investee companies contribute 20%. But recently we got approval from KfW to say, well, let's increase the threshold from 80% to 90% so that we can deploy more and make it less costly for the portfolio companies to get this tier project completed. Recently, we got another DFI from Denmark who's interested to put in additional capital. We presented to them our case, and they said, oh, wow, this is what you've done in Africa. Good job. You're creating more social impact. Let us give you more capital. So we're getting to $70 million fund right now.
Oh, great.
Yeah. I think two things here that I would like to rebound. I think you mentioned something very important, and Ulrich, you referred to that as well, as like the first mover. You need someone to trust you to start building the journey, and this is where I think Catalytic Capital is really super key, is to get a funder, a trusted funder ideally on board to follow you, and then you can start building from there. And then on your point, Harry, what we have found quite impactful and effective from a mobilization side is using guarantees. So that is, I think, for us a way in which we can really attract substantial amounts of money, but still you can have the 96% lined up, covered by guarantees. You still need that 4%, right, of catalytic capital that follows you. Yeah.
Just don't call it a first loss guarantee.
No.
Call it something positive.
Yeah.
Yeah.
Catalytic enabler or something. And then a final point before I open to questions from the room is sort of building on this. I think observationally, having been sort of deploying catalytic capital on the continent for over a decade now, a lot of the money being catalyzed is itself usually publicly funded or sort of privately impact mandated, and we see very little examples of like genuine private capital mobilization whether they're global pools, insurance companies, banks, pension funds, or local pools, the same archetypes, or even local high net worths on the continent. I'm intrigued sort of what people think, one, the big barriers are to that, and two, any kind of interesting examples where people have managed to kind of overcome some of those, because I think, KFW mobilizing other DFIs is great, but it's probably not the reason what we're trying to achieve to really unlock sustainable development in the long run.
Well, there's perhaps one local example and perhaps a global example as well. The local example that I find very intriguing is that at Ghana, where we support a fund of funds that managed to crowd in pension fund money, 30 million with 10 million of catalytic finance upfront. So the intriguing part is that the regulator follows suit and is actually promoted and pushed the pension fund into this space, because unlike European global pension funds, the pension fund in Ghana in particular has been burned by government default. So for them, this asset class, venture PE, is somehow less risky than. So yeah, there is a context to this, but it's also an opportunity in a way. I mean, because it diversifies their asset base, etc. So here, the story is really solid work with the regulator, with the policymakers, together with work on these actual vehicles, can really move the needle in terms of mobilizing local pension funds in this case. And globally, we are trying to, with Scaled, some of you might have heard of it. It's a large fund of funds with Allianz and other global investors in there, as well as 6 governments, trying to standardize also investment standards. I mean, all the legal documents, et cetera. So that's actually, one of the hurdles actually is that the documentation, the protocols is just so diverse. So they're bringing all the donors and the large investors together and saying, well, why don't you standardize your documentation? So that's perhaps 2 examples that.
Thanks.
Yeah, I mean, I think you raised a good point of like de-risking DFIs, and I agree that we see that too much. We have started to see some on our side, some family offices actually coming in, and family offices from the Far East, from Europe, really interested in impact, and I think those are kind of the green shoots we are starting to see. But what's also interesting to see with those family offices, once they start getting engaged, they become more engaged. So they start off with, okay, we want to do impacts, and they might do something which is fully impact, but once they see it's working, they're like, hey, wait a minute. You guys are also doing something direct. This time maybe we come in alongside you. And that's the kind of development which we really like to see, where they're really opening up to the opportunities on the philanthropic side, but also on the investment side, and seeing really the benefits. And I think that's these are kind of like the vanguard, the tip of the spear type of parties. And we'd like to see that more, because they have friends, they have other family offices. Hopefully that gets more of them into this.
Yeah, and I mean, working for an impact-focused family office, I think the unique part family offices have is, one, their flexibility, but like one of the barriers to like real institutional capital is scale, right? You need minimum $100 million structures, often $1 billion, for people to look at it. And I think family offices can think very differently from a sizing perspective, while still controlling huge amounts of assets, right?
Yeah.
Which is, Julie, or?
Yes, I think I alluded to it already. From our perspective, it's really about the readability of what we're trying to do. So just the fact that children are the big absent of most of the investment criteria. We're actually, as Save the Children Global Ventures, also supporting the work around children's investment and trying to build the framework to fit it into our funds, and to work on KPIs that make it more readable, and that will also help to provide data for investors, so that they can understand what we mean when we say invest in children. Is it just schools, or is it also health facilities? Can it be an SME that provides services that produce positive outcomes on children? I mean, women heads of households is also a big topic in sub-Saharan Africa, especially. I think really providing the keys to build the market is something we're really trying to work on.
Yeah, thanks, Harry. In addition to the DFI funding support in our fund, we have high net worth individuals, family offices in the US that are supporting us. Smaller ticket sizes, but it's very helpful. They like our strategy in Africa, but I mean, in terms of, we are clear in terms of the social impact story. They love it, but it's a matter of making them believe that, well, when we do, let's say, a $5 million deal for 5 years, then our capital is going to come back. How do you prove that? I mean, so our investments come with credit enhancements. So we benefit from different security packages, for example, share pledges if there is. Parent guarantees if there's a holding company, sort of like if anything goes wrong, then, well, we know that at least we have something to recover our losses.
Great,
Yeah.
Thanks everyone. I think we've got about 15 minutes left, so we'd love to open it up to questions. Gentleman at the front. If you want to briefly introduce yourself as well. Hi. Briefly, I emphasize.
Hi, my name is David Fitzgerald. I'm the founder of Ed Partners Africa. We have lent to about 700 low-cost schools in Kenya, and we want to make it several thousand. Just to say that borrowing from local banks in Kenya and borrowing from international vehicles is possible to a small extent. Credit enhancement, enormously helpful. The DFC, we'd finalized all the deals for a $10 billion guarantee, and the ink was wet on the paper, but Mr. Trump changed his mind. So what I'm trying to say is guarantees from anyone is incredibly important in unlocking both local and international capital. And as you all know, the proving the business models you can finance low-cost education is the message or is the mission which has been achieved in microfinance and needs to be achieved in education finance.
Okay. Gentleman over there.
Thank you very much. My name is Ben Zwinkels. It's exactly this year, 50 years ago, that I started to work in Cameroon. So time is flying, and I've seen how Africa is developing. I worked also 30 years for FMO as a DFI, and the last years were Africa Invest sharing, and Pan-Africa Investment Fund, which was growing for 4 million Dutch guilders to 3 billion now, and we have 8 offices. The question now is, I'm leaving Africa Invest with a long career also, 17 years as chairman, and I'm now busy with the microfinance bank in Nigeria and a commercial bank in Liberia. And I am already 2 years writing to organizations to help at least Liberia, because Liberia is one of the poorest countries. And I must say, I'm trying also to set up horticulture projects, like in Cameroon. I'm trying to get GIZ, but no one is answering emails. No one is answering requests with full of documentation. And I think Africa is 45 or 54 countries. I have seen them mostly all, but I think with all these organizations, what we need is how can we interact much better? I know Africa very well, I know Cameroon very well, but if I come with an agriculture project improving the seeds, producing seeds, and the Dutch, I'm from Holland, the Dutch are quite good, but it's very expensive if you buy from Dutch suppliers, and Africa can produce, and I go to these organizations, and there is no answer. So sorry to say that, but I think I look this as a very good opportunity to also to exchange with you, children, food, seeds, growing tomatoes or vegetables is all now going on. It's from Senegal to Malawi, everywhere, the agriculture, and they need seeds, but I don't get the answer. And my letters are very polite. Thank you.
I guess.
Yeah. How are we doing on time? Sorry. 11 minutes. Oh, great. Yeah, and I understand your frustration. And I think for those of us both on the sort of philanthropic and asset owner side, I think most of us would admit that both our own coordination as entities and sometimes our sort of engagement with potential partners, is not always perfect. I think the caveat is the demand for these things is huge, and probably the reason replies aren't coming is people have 1,000 emails, asking for the same pretty limited pot of money, and sadly these pots are getting smaller, right? So, which is just a reality.
Yeah, that's what it means. Sorry, so not mention that. I mean, from our fund, we invest anywhere in Africa. I mean, the Francophone region has been very tight for us in terms of pricing, very low against our return targets. I think if there's a country where we see high country risk, we try to get in there, but we need to make sure that there's a guarantee mechanism in place. Nigeria is coming right for us, very interesting market. We just closed a deal, a $3 million deal with a company called BeFree. BeFree are an ethical debt collection company that buy distressed loan assets from financial institutions in that country. So, I mean, yeah, we are open to, if you have an IFI opportunity, feel free to reach out to us.
Okay. Yeah.
Right.
And on the GIZ point, I'm happy to exchange with you, and I can happy to introduce you then to the country director there in Liberia.
Maybe just one reflection. I think that I totally hear you, and I really feel that. And we sit next to UBS, and one of the things that we struggle with a lot, and I know that the Dutch organizations, Dutch banks, FMO have also struggled with this a lot, is particularly when you're starting to do investments, facing extreme growth and proliferation of compliance, etc. And what the effect of that is that you need to start writing bigger ticket sizes, because you can't do the admin on these very, very small deals. And it's really, I find it a plague, to be honest. It's really just exacerbating. The bigger these teams get, the more work they invent for themselves, and it's a self-inflating balloon, and it's really terrible, I must say. And we struggle from it a lot at the moment. And yeah, that's an issue we face. And I mean, in a way, if you think about how this went in the past, you basically had a rich benefactor, and he would say, look, I love the work you're doing. I'm going to write you a blank check for 50K, 100K to get you started off, come back in 2 years and tell me how it went. And we kind of need more of that kind of funding to get some of these great initiatives and these really innovative solutions off the ground, rather than endless compliance checks.
Great point.
Which are needed, but yeah.
Perhaps a little bit linked. My name's Susie. I work for the Global Off-Grid Solar Association, and we've had a couple of really great examples of blended finance structures in our space. I have a great report if anybody wants to see it. But one of the things we found with those is that they actually take quite a long time to kind of bring all the actors together. So I'm wondering if you might have perspectives on how we can try and speed that up, or if you have examples of where that's gone particularly well.
Anyone?
Well, I think you spoke about the renewable energy and energy space in general in sub-Saharan Africa. I think generally speaking, that's a good example of where blending and the contractual environment has really helped crowding in actors. And I think to a certain degree, this is also what we are not trying to replicate, but really through improving readability and through building markets, improving investability. We really want to help prove the case. But yeah, I hear you around the fact that every blended finance transaction is somehow bespoke, right? And then you end up with volumes and volumes of documents, different reporting requirements from every DFI and every funder, and so it can be quite cumbersome. So we're trying to, as I said earlier on, build the funding vehicles that fit a certain funder's appetite as well, so that we kind of group funders together in one blended finance vehicle that speaks to their needs, and then
Yeah, and another point that we are trying to look at is now how to support first-time fund managers to, get going, get a track record, because it's a chicken and egg issue, of course. Without a track record, you don't get any funding, and vice versa. So we are trying to set up these, support vehicles such as a warehousing facility, working capital facilities, so they can get started. We support them with peer learning, et cetera, to get them going, and then also be able to set up the blended finance structures that to bridge the gap, basically, all the way to funders.
transaction costs are an issue as well, right?
Two quick things, Jesse, just from my perspective on that. I think one is that BII and BCG did this great piece of work earlier in the year on sort of trying to kind of somewhat create a typology of blended finance and what are all these modalities. So I think, because part of the answer, particularly to scale, but also to solve some of these cost questions, is simplify, right? If there's 6 typologies, why can't there be a standard documentation and you can just move some numbers around depending on ratios and things like that? I mean, I'm not a lawyer or a compliance person, so I'm sure it's more complex. But intuitively, that feels like something, why are we building new things every time? That's not how mainstream finance works, right? It simplifies and it commoditizes. And then I think the other observation is, one of the challenges in our space is the very long decision-making arcs of development finance institutions. And ultimately, unfortunately, particularly in Africa, they're basically the only game in town in 90% of cases. And so I don't know how to fix that, because it's not the people who work there's fault. It's like a decision-making structure that, is sort of part of these quite big, often, complex organizations. But that's not how, in the private sector, nobody's spending 2 years working on a 15 million transaction. It's mad, right? And so I don't know how to fix that. It's very easy to say this. I don't work for one. I work for a smaller organization with a single decision maker. But I think, particularly for those of us who are flexible, we almost have to wait till they've got their ducks in a row before even looking at stuff, because we don't even know what it's going to look like. We like a strategy, and we're ring us when this anchor DFI has worked out what they want. And I find that frustrating, because some of that stuff just falls away, and it feels like there's a lot of lost sort of both momentum, but because momentum's important, there's an urgency to get capital deployed, but also just things just fall away sometimes. So just 2 quick thoughts from my perspective. I'm not sure I'm allowed to talk as the moderator. I'm not good at not talking. So I think probably got a couple of minutes. Yeah, any more? The lady.
Hello, my name's Jackie Doughty from Films for Change. It struck me, having been to a lot of these panels and talked to a lot of investors over the last couple of days, that for some of the sustainable development to continue and to carry on well, the whole idea of what your ROI is needs to change. Because it can't always, surely, in this world be about financial. It needs to be about seeing the development of children. It needs to be seeing trees being planted. It needs, but how do you quantify that for an investor? I'm in a very difficult position. We've crowdfunded a 3-part documentary in the Rwenzori Mountains to stop the glaciers melting. It's a fantastically positive story, but looking for investment money and impact money, where we can show these villages along the Rwenzoris and in India and in all over the world, in faraway villages high up in mountains, where it can really make an impact. We need solar cinemas to get up there. We need all sorts of exciting things, but I don't know how I measure that for you. So at what point do you see any kind of change in what ROI is?
And then we had a second question. I wonder if you want to say it briefly, and then anyone can chirp in with reflections.
Hi, Nick Salmon here from Petula Partners. We are an Africa-focused corporate finance advisory firm and have a private credit asset management business as well. More of a question for Ulrich in relation to the success he's seen in Ghana with getting pension funds coming in on a sort of catalytic basis. Where else has he seen success, and is it more about education or getting the structure right when you look at African pools of capital coming into various situations?
Yeah, I don't know if anyone has any, sorry, I didn't remember your name, reflection on the lady's comments, or if Ulrich, you want to take that.
Yeah, perhaps I can start with that. So it's a first. It's a first mover story. I mean, there's, of course, a South African pension fund, SME fund that actually invests also in venture PE. But otherwise, in sub-Saharan Africa, Ghana is really a first mover. We see now some replication efforts. So Uganda is looking at it quite actively. So, but yeah, is it education or structure or both? It's really both. I mean, I really believe it's a lot about a success story, a demonstration case. Ghana having positive results. But it's also a lot, I mean, we're talking regulators, no? I mean, they need a lot of education and comforting, and that takes time. So yeah, it's really both.
I think we're out of time, but I have some thoughts, so I'll come back to you now.
Sorry to.
Well, thank you to the 4 panelists. I hope it's been interesting. It certainly was for me. Yeah, and if anyone's got any questions for everyone, I'm sure you can come and grab them as we come off the stage. Thank you.
Right. Thank you.